So since we're talking about what you should focus on, I thought this is a decent transition here. Benjamin Graham is referred to frequently, uh, particularly because Warren Buffett talks about that's his process, is what Benjamin Graham created a century ago, essentially, that we should be looking at the whole picture as Perry has just described. And there's lots of stuff that gets us focused elsewhere, and one of which is um, Lee here left J.P. Morgan back in 14 to start his own advisory firm called Fundstrat Global, which serves clients in 26 countries. So I mean, it's a big deal when Tom Lee says um, this market is a bargain or this market is dangerous. Since he nailed it over the last decade, it's kind of important to pay attention to what he has to say. What has been happening, as Perry has alluded to, is that people have been holding their nose and buying stocks without giving a darn about valuations or the macro economy. However, that's resulted in buy the dip, and it's been a fairly effective process over the last decade or so. But every piece of financial literature you've ever read says somewhere on it, past performance is not indicative of future results. And people that don't make daily appearances on CNBC, like, say Warren Buffett. I mean, he's virtually never on TV. Right now, they're taking a different road. There's a fork in the road every day, and Warren Buffett and others following Benjamin Graham's processes have been building cash. The momentum behind the Magnificent Seven has basically hit an air pocket, creating the unauspicious bearish chart pattern known as a descending triangle. And that's here and more prevalently, more significantly, here of late. Buying demand in the Mag 7 has waned, and the group basically has been bouncing around a significant support line. Bulls want to see buyers dig in here, which they did to a degree on Friday, but not so much in technology as they have been paying more attention to broader issues in the market. But without this key offensive group, the cap-weighted investors are going to have a hard time making progress in the coming months to see the new all-time high that everyone is waiting for. Now, there is a benefit to sell-offs in the market, one of which is the Magnificent Seven is no longer as expensive as it was. The forward PE ratio that Perry was just talking about is typically traded in a range of 30% to 65% above average compared to the S&P. If earnings continue to come through, the group's current 32% premium to the overall market doesn't look all that expensive, though this last week, NVIDIA's earnings were up and investors said that wasn't enough. Yeah, we know they're up, but your forecast for continuing exorbitant gains has weakened a bit, so we're not impressed. So the combination of a downshift in returns and resilient earnings estimates has led to a drop in relative valuations. Stocks within the Magnificent Seven are increasingly going their own way. They have, in the past couple of years, they've been highly correlated. Everything going up, except perhaps Tesla has been kind of an outlier on whether or not it's going to follow the rest of the crowd in the seven. The median one-year correlation of these seven stocks to the cap-weighted Mag 7 has trended lower. So each one of them is kind of having to justify to their own investor group whether or not they're worth continuing to hold the faith. The Mag 7 index over the past 2 years is now about 2.5 standard deviations below average, and it suggests more discretion is needed if you're going to buy the Mag 7 as a group or individually. Now, when we look at the stock market, one of the things that is often ignored is the general economic health of the country. We want to be in a growth cycle. Growth cycle means growing earnings. Growing earnings mean that we're making better profits. And if we have better profits, the stock price should be higher. We could see new all-time highs as we have in recent years. So when we look at the market, it's not the stock market. It is the market of stocks, or more significantly, the market of sectors. When we look at the macro conditions, we're looking for sectors that do well in periods of economic growth. And there are these three sectors which are the keys to understanding what's going on in the economy. That's technology, consumer discretionary, and financials. So let's take a look at those. Here's the broader tech sector. And it's been doing a lot of bouncing around, which is pretty clearly to see. Now, this chart is compared to the S&P 500. So there's two tickers here, XLK and SPY. When the chart is sloping down and to the right, it means that the second sector is the winner to hold. When it's moving from the left upward to the right, that means the first ticker is the one that you want to own. And clearly here, since last summer, the trend has been for technology to continue underperforming the broad market. As the economy slows, there's probably more room for valuations to contract, and that would mean a further drag, though independently, investors may buy the dip and create significant bounces in price, but they have to hold. And if they don't, then this trend continues. Basically, we see about a buy the dip here, a buy the dip here, a buy the dip here, and it looks like we probably had one on Friday. Let's move on to consumer discretionary, which when we look at the performance of all 11 sectors in the market, this is another laggard. It had been a leader, but as I just explained on the last slide, when it's moving from the bottom left to the upper right, that means that your primary ticker is winning. In this case, that's consumer discretionary. But the latest news from the retail sector has been negative, and it's showing up in this sector more than elsewhere. The retail sales numbers from last month should be concerning if they're signaling an emerging trend of consumers finally tighten the purse strings because they're worried about multiple things: inflation, jobs, perhaps some other factor, tariffs, war. And after Friday's televised press conference meeting between President Trump and President Zelensky, it's just one more thing to worry about for investors and become a little bit more cautious. The next sector that would be doing well if we were in a period of economic growth, macroeconomics advancing, would be financials. Now, this is in the group of cyclicals here, and they've basically been a mixed bag over the last couple of weeks. But financial sector does well. It's a function of interest rates and economic potential. And last week's data shows potential trouble in housing, retail sales, economic activity in general. And that would be a negative for what banks need. That's growing their loan portfolios, having borrowers come in who are healthy, can afford to pay back the loans that are made, and then having growing margins. Those two things are necessary. Now, if we have a macro condition that is headed into a recession, then we're looking for these three sectors to do well. This is healthcare, consumer staples, and utilities. So let's take a look here. Healthcare has been a laggard, but it is now turning into a leader. At least it looks like that. So while this is dropping, that means that the S&P 500 is doing better. There was a rally here last July, which petered out, and it it did not help your portfolio to be diversified into healthcare from last July until this January. And finally, we're starting to see a little bit of a um, advance in the returns it's providing. It's become one of the better sectors as for performance on a year-to-date basis, and we had a strong uptick last week relative to the S&P. So this could be a big winner if we get a prolonged market downturn. There's still a lot of stops and starts in this trend, and it does need to be a little more persistent to feel that there's some real sustainability and that the sector may actually have some legs and benefiting a portfolio. But right now, we have 2 months of improving, but not enough performance to confirm that risk off recessionary structure of a portfolio is yet the place to be. The second area is consumer staples, which have clearly turned into a leader. I mean, it had a rally last July, kind of lasted up into September, but overall, this trend over the past year has been that the S&P 500 has been a better place to be than in consumer staples until just recently. Over this past month, there's been a phenomenal recovery here, and this sector has moved from damaging your portfolio to becoming a leader. It was incredibly slow to respond to what we're watching is a defensive shift showing up in other areas of the market. But now that it's basically the switch has been turned on, it's becoming one of the market's best performers. Now, we've heard a lot about consumer troubles or the current troubles in the retail sector, and that's showing up very decisively here in discretionary stocks being weak, and the consumer staples are gaining attention. It's pretty much a textbook case of shift in investor sentiment to defense rather than growth. The third key sector is utilities. Utilities are generally purchased for their dividends because they are slow and steady, because utility companies need government approval to do much of anything. They can't raise their prices without approval. They can't raise their dividend without approval. They can't expand their service group and their services without approval. So anything that has to be done here just requires a lubrication of government action to make it happen. But it has shifted, and it's showing signs of leadership. Now, they haven't outperformed to the degree that healthcare has so far this year, or even consumer staples. But this is a slow and steady ascension of this ratio, telling us that utilities, which have historically been avoided, are now outperforming, confirming the macro conditions that there's fear among investors of a slowing economy. Growth is out of favor. Defensives are broadly participating now. And if this continues, then we could see some real outperformance in the coming months. So as a summary of the three, here's basically where we are, is that on the growth side, the three key sectors are all underperforming the S&P, and on the recession side, the three key sectors are all outperforming the S&P. That should hopefully reorient you from the headlines that are coming, if any of the headlines that you're paying attention to. So let's take a look at a couple of other sectors here. This is communications, and this basically indicates that the huge rally that we've seen in Facebook or Meta is probably over. The sector itself is healthy. It has this upward trend in here. That's positive, but a little pullback here tied to the dominance of Facebook inside the sector. This stock basically has helped support the Magnificent Seven as a part of a portfolio. And right now, as far as the sector concerned, the traditional telecom and media piece has got a bit of a revival because they're generally more defensive in nature. So the gains in recent weeks have been relatively good. And this suggests that there's probably more to come in the way of outperformance from the communications sector. When we take a look at bonds, which are evident in most people's portfolio because they're in a 60-40, 50-50, 40-60 kind of range. That's where most people answer risk questions. And so whether it makes sense to own bonds or not, they end up owning bonds. In fact, I had a client meeting recently who got tired of a portfolio that he owns holding 40% bonds for the last 4 years and losing money. And he complained to his other advisor that he didn't like. He finally had his fill of it, said just sell those things. But over the last couple of months, well, now we're at the end of February, so I can say the last couple of months, treasuries have actually been strengthening so far this year, despite the fact that inflation is ticking higher and despite the fact that tariffs continue to suggest you should be looking at a defensive posturing. The one thing we haven't seen is treasuries outperforming stocks. When that begins to happen, then the recession scenario anticipation by professional traders is probably in full force. The bond outperformance over stocks is the one key factor that we haven't seen yet. What we have seen is that as the U.S. economy has been slowing down, international stocks have continued to be the place to be. Had another client meeting this last week. And so why are we in foreign stocks? I don't like the foreign markets. Well, we're here to be in the leading performance sectors, and it happens to be international is outperforming the U.S. stocks. If you wanted to have better returns, you have to own internationally. The macro conditions overseas are improving. Now, we're not going to get into the ins and outs of who benefits and who is hurt by macro or by tariffs, because tariffs appear to be negotiating posture from President Trump rather than absolute implementation. The U.S. economy does appear to be in better shape on an absolute basis, but the stock market's forward looking, and that's because the general assumption about implementation of tariffs is inflationary and will slow things down. And in that sense, the odds of recovery in Europe have actually been outweighing the potential slowdown in the United States. The outlook for U.S. banks is takes a potential hit when we've got a series of data suggesting a slowdown in the U.S. economy. The outlook for European financials is still a bit mixed because we haven't seen the ECB take a strong position that they will continue to reduce interest rates. And the region's economy is kind of struggling with whether it's going to grow or stagnate, but it's still better from the financial standpoint for European financials rather than U.S. financials as things stand right now. The real estate, we have a trend of lower long-term yields coupled with the simultaneous outperformance of real estate investment trusts. And that because they generate a high dividend, typically higher than bonds pay, it suggests that investors are becoming more risk off. And that confirms what we see in the other defensively oriented sectors that I've just briefly reviewed. So we'll see how long this trend lasts. If the US economy is indeed slowing to the degree that the manufacturing data suggests, then we're going to see more outperformance of real estate. And we look at that and say, how can that possibly be with all the bad things we hear about real estate? But we also have the Doge pressures and ongoing weakness in commercial real estate. They just simply don't seem supportive if you have more layoffs coming from the federal government, but the federal government is only 6% of total employment. Now, it's really important around Washington, D.C., but if you spread it out the rest of the country, it has a much less significant impact. But as I mentioned, Washington, D.C., this graph came from Zillow, and it shows new home listings in the DC area over the past 14 days. Doge layoff announcements or fear of being laid off is causing people to say, I better sell my property while prices are still up. But it looks like the competition has suddenly increased. And on top of that listing increase, about 17% of people are already reducing their prices that they're asking for. Now, if the U.S. housing market has been essentially frozen because of the gap between current mortgage rates and the rates that many homeowners are locked in at, this could be the catalyst that unsticks it. Doge could create some seismic shift in the housing market, but I believe that's primarily limited to the DC area or other communities that are dominated by government employment. Now, what do you do about that? Well, our process is, as I walk through these individual sector slides, is to explain that things change in the market. There's rotation that occurs, and that occurs in our portfolios. So this is where we were last month, and this is where we are presently. Now, we use technical analysis because it is the study of market behavior and therefore market participants. It's an examination of how humans behave through the simple actions of their buying and selling and what they're willing to pay for or sell at is the official arbiter of truth. If you've been with us before, you know we are not in the prediction business. We are in the interpretation business. Paying attention is what is necessary. You do it or you pay somebody to do it for you. It's just simply a dynamic market, and more so with the new administration. There, even among professionals, there are basically two groups of people. Some of them are on the buy are considered buy side, some are considered sell side. It depends on what their primary focus of how they run portfolios. But they're confused. There's just simply no agreement that we would typically see in a more normal market. This is not a market for slackers. It seldom is. Someone needs to worry and watch and make a decision based on what conditions actually are, how they have adapted to the new inputs into the economy. You can do this. You can hire us to do that.